All right, welcome to our February 19th class. Today we're going to talk about economic statement conversion and set up your next homework, set up your next homework 3 assignment. So if you had watched the video and read the text, you would have gotten the simple economic statement conversion that was done based on the example in the lecture notes and in the book. So we had started with the financial statements, and from a process standpoint, what's going to be very important about the process is the labeling of the process. So labeling everything operating, non-operating, debt equivalent, equity equivalent cash flows, then converting the statements. And again, we need to convert the income statement and balance sheet before we can create the cash flow because the cash flow statement is a function of the income statement and the balance sheet. So in this case, we started with the balance sheet first, and the converted balance sheet became the TFI, and the converted income statement became the TII in the video, and the cash flow statement was, excuse me, the statement of CFI, or cash flow available to investors, which represents the cash coming from the income statement minus the changes in investment on the balance sheet. So once we have converted the economic statements, we then want to also calculate what we would call an economic profit statement so that we can get our ROIC and our economic profits. So what I'm going to do is I'm going to take the file from the video, which was posted on Canvas. So if I log into Canvas, in our class under the Files section, I had posted a file so I thought I did. Well, I'm going to post it right now. This was the video file. So let me rename this the video file for the conversion. I'm going to post just so you can see what I'm doing to Canvas. Oh, I did. It's called Economic Conversion Video. Take that back. All right, so let me not confuse ourselves. Sorry about that one. So economic statement conversion video, that was the file. So I'll download that one so we're all working out the same file. Good. So once we've converted the income statements and the balance sheets, we will then create a fourth tab called EP for economic profit. And to do the EPs, again, I'll make relative reference to the years, last year, current year, and label. What I want to do is there's two ways to do economic profit. The first is the spread method using ROIC and a cost of capital. So I need to calculate my ROIC, and in this case I'm going to do an ROIC based on beginning of year invested capital. So how do I do that? Well, I'm going to need my NOPLAT, stop my TII, and that was my 1, and I'm going to need my invested capital off of my TFI. And make this a little bit wider so you can see the 2 years. Now, there's three ways to calculate ROIC. There is ROIC based on end of year, which is if I take my current year's NOPLAT and divide by my current year's invested capital, that would be my end of year ROIC. In this case is a percentage. I could do my end of year ROIC based on beginning of year, which is take my current year's NOPLAT and divide by my previous year's invested capital. And I could take an ROIC based on an average invested capital, which is I take my current year's NOPLAT and I divide by last year plus current year divided by 2. And I then get an average invested capital, or return on an average invested capital. All three of those methods would be used in the real world, and we would ultimately identify what was appropriate to give us a better understanding of the valuation of the company. But in this case, what we're going to use in this class, unless I tell you otherwise, is typically what's called a BOY, B-O-Y, ROIC. And the reason we're going to do that is that when we do the valuations of the companies using the economic profit valuation methodology in the DCF, we get an identical answer. So I'm going to set up our ROICs so that we will get the same identical answer when we do the two valuations. So in this case, what I'm going to do is take the current year NOPLAT divided by the previous year ending invested capital, and that is my return on invested capital based on beginning of year data. It's going to assume a 10% WACC, which will be given to you on the exam, and that would get you something called a spread. Spread is the difference between the ROIC and the WACC. So I then take my invested capital, got my spread, 1 equals invested capital. And if I take my spread, EP equals spread times invested capital. So what I would do is I would take my spread times my beginning of year invested capital, and that would be my economic profit. Now, method number 2. Method number 2 is I take my NOPLAT and I subtract it's called a capital charge. And the capital charge is going to be the invested capital times the WACC. So in this case, it's going to be my beginning of year invested capital times my WACC, and that is my capital charge. Another way of saying that is if I borrowed $375 million from an investor at a 10% expectation, they would expect me to make $37.5 million on that borrowed money. Therefore, my economic profit, which equals my NOPLAT minus my capital charge, equals the 210 minus 3750, is the same 172.50, 2 decimal places, as it was in the other method of doing it. So the key point to economic profit, especially using the beginning of year method, is that we get the same answer using 2 ways, whether we use what's called the spread method or whether we use the absolute method for calculating our NOPLAT. Now, what we've done here from an analytical standpoint is we've now put our statements into this sort of financial perspective on an economic basis, so that I have go back to my balance sheet into the Modigliani format. I have my operating assets, I have my non-operating assets, and that together becomes my TFI. Well, if I think about it, I've now made it easy to calculate the concept of an ROIC. So in this case, I'm going to do this based on a little bit bigger to see. I'm going to do it based on an end of year basis, ROIC. Actually, I'll do beginning of year just to be consistent. Beginning of year ROIC. Well, what's ROIC? It's my NOPLAT divided by my invested capital. So I can quickly, by putting everything into the economic format, get my ROIC, get my economic profit, get my free cash flow, which is in the CFI format, because those are going to be the key variables that we're going to use when we value a company. So here's the thing. The average return on invested capital on an operating basis is, as we just saw, 50%. But what I can also do is I can also get my non-operating ROI. So basically, if I earn $3 million on my non-operating assets, in this case, last year it was 15, then I'm actually making a 20% return on my non-operating assets. So that on a TFI basis, return on TFI, I'd be making my total income available to investors divided by my total funds invested. So here's the thing. Now this example has relatively small amounts of non-operating items, but the thing is that Bloomberg, when we look at ROIC in Bloomberg, as you just did for your analysis on Starbucks, what you actually did was looked at what we would call a return on TFI. What the rest of the world conveniently calls ROIC is the return on the debt and equity in the business. And we know from a TFI standpoint that debt and equity is TFI, which means they're looking at a return on the operating and non-operating investments combined. So the real point here is that the way we're going to start looking at a business is that Bloomberg ROIC, for the industries that we just looked at, would say this industry is making 54.6%. But what this industry is actually doing is, in an operating basis, it's making 56%, and in a non-operating basis, it's making 20%. And the reason this becomes important is because when we grow the business, we're not growing the business making a return of 55%. If we grow the business on an operating basis, we're actually making 56% going forward. So in a way, we would be underrepresenting the performance of the business as it grows, because we would be over allocating the amount of investment, because we would include the non-operating investment in the business, in order to grow our profit. So again, Bloomberg is taking a NOPLAT and it's dividing by the TFI to get ROIC. So it's kind of ignoring that non-operating return on investment. And it's going to be important for us to forecast those out separately to truly understand the performance of the business. So that's what we're doing here. And we can clearly see that we're doing this because we have separated out into operating returns and non-operating returns. This is going to be a very important point when we get to the valuation models, because in the valuation models, we are going to value the operating assets separately than the non-operating assets, and we're going to project a return on investment on the operating assets, and we're going to project a return on investment on the non-operating assets, and those are going to continue to grow at different rates. So we're going to have to project them out at different rates. So this is the example of the converted statements. So let's go through this process one more time with more difficult statements. So I'm going to save this, and I'm going to call this version 2, and I'm going to take this version 2 and I'm going to put it back here on Canvas. So the file that I've just done with the webinar video is now available here on Canvas. So here's what I'm going to do next. I had put up a practice conversion document and a practice conversion solution. So what I'm going to do is I'm going to go through a quick example of that practice conversion. So if I take our practice conversion, had 2 years worth of data. Unfortunately, I have to quickly retype them. It's a PDF. On your homework and midterm exams, I will give you an Excel file. But I have revenue, operating cost, I have depreciation, EBIT, interest, expense, income before tax, tax, net income, and dividends. And those numbers were 230, 270. Negative 160. Negative 190. Depreciation was negative 40, negative 50. Gives us EBIT of 30 and 30. Interest expense was negative 10. Negative 10. Income before tax with EBIT minus the interest. Taxes were 5, suggesting a 25% tax rate. Negative sign in front of that. And that gave us net income of 15 and 15. And we had dividends of 6 and 12. All right, that was the simple income statement that we were given. So I'll just call that my data. And then they gave us a simple balance sheet. So operating cash, marketable securities is going to be called excess cash on your homework assignment. So again, the major difference is excess cash is going to be non-operating, and it's the cash that we can pay out, whereas operating cash is operating, and it is the cash that's tied up in working capital that can't be paid out. Equity, investments, and that would give us assets. And then on the balance sheet, we have accounts payable. What do we have next? Long-term debt. We have common stock, which often include the additional paid-in capital, and we have retained earnings. Okay, so operating cash, 12 and 14. Excess cash, 73.24. Receivables are 40 and 50. Inventory is 165. Net PP&E is 400 and 500. And I will not make you go through this tedious process of an assignment. I'll have done this in advance. 20 and 30. And that should total up my assets 645 and 683. And this would be 95, 130. Debt is 200. Common stock is 50. And 300 and 303. So theoretically, if I sum these up, I get the same liabilities and equity as I do my assets. All right, so I'm going to call this the practice solution in Excel so that I can upload this later. So there's a labeling process that we would next need to go through. And we need to label the income statement and the balance sheet. As I mentioned in the video, one shortcut that we can make on the income statement is that everything above EBIT, also typically known as operating income or operating profit, is operating. So we can start with there as our ones. Interest expense comes from the debt, so that is 3. Taxes, 1, 2, and 3. Income is 4. And dividends, we don't really have to label. It is a 4 cash flow. It is going to not show up on the TII statement because TII ends with net income. But nonetheless, it is going to be something important on our cash flow statement. All right, operating cash is operating. Excess cash is non-operating. Receivables is operating. Inventory is operating. PP&E operating. Equity investments non-operating. And assets are the sum of the ones above. So, first statement, I'll do the balance sheet first. TFI. Make it a little bit bigger. I'd recommend doing 1 tab per statement so it's easy to copy things over using relative references, copy over my years and my labels. And what's going to be important is to aggregate all of my ones, everything that's operating together to get what we call invested capital. So I take my 1 assets, in this case operating cash. I then have receivables. I then have inventory. I then have PP&E, and then I take any liabilities that are ones. I have accounts payable, which I forgot to label. So let me go back to this one. Label my 1, 3, 4, 4. All right. And what I then do, copy and paste the numbers over. I can see I have my ones aggregated together, and I have my invested capital, which is going to be anything that is an asset minus anything that is a liability. So that would be my invested capital. Now, what I did in the video, I would also probably want to do here. And as I said, this is a correct invested capital. So for purposes of this homework assignment, you don't have to break out working capital and long-term capital separately. However, after the midterm, when we do valuation, we are going to forecast working capital at a different rate than PP&E. So we're going to start the practice process of separating these out. So practically what I mean is that invested capital, I'm going to move down a couple rows, take PP&E, I'm going to move it outside of working capital. And I'm going to put my working capital items together. So I have what we call operating working capital, which is my operating current assets, minus my operating current liabilities. And then I have my long-term working capital, so that invested capital equals the operating working capital plus the long-term. And that would also be my invested capital. Now, on the homework assignment that you're going to get, you will have some longer-term operating liabilities. So just as we subtracted accounts payable from our current assets, we would subtract any long-term operating liabilities from our longer-term operating assets. So again, invested capital is netting out the assets against the liabilities. We're doing that process 4 times on the TFI statement for each one of the sections. So in this case, I get my invested capital, which again are my netted operating assets against my netted operating liabilities. All right, I do the same thing for my 2's. So 1 plus 2 equals TFI. So in this case, go back to my data. Anything labeled as a 2 on an asset side, anything labeled as a 2 on a liability side, I then move over. I don't have any 2 liabilities. If I did, I would net those out. But essentially, when I add my 1's and 2's together, I get my TFI. So I'll just add my invested capital plus my 2's. Excess cash is the only 2. And that is my total funds available to investors. How am I financing that? I'm financing it by any 3's, any debt, and any 4's, any equity. And if I add my 3's and 4's together, I get a mistake. Or did I mess up? So here is, just double check. Plus that, plus that, and that plus that. So here's the nice thing about the spreadsheet is that in the solution, if these two sides don't add up, that means I'm probably missing something. So, in the interest of time here, let me figure out what I forgot to put in here. So we go back to my TFI. Oh, I'm missing a 2. This is why labeling is important. When I told you to put all the 2's together, I forgot a 2. I was doing this very quickly, and I put in 1 2, which is the excess cash, but I left another 2 out. This was my Lego on the floor comment that I made in the previous video. I'm missing my equity investments. Now, if I didn't quickly look at the solution and I was doing this in a longer period of time, I would have told you that the first step would have been to go through the labels. That's why labeling can help you as you go through this and see if you missed anything. And so if we'd actually track through all of the 1s, 2s, 3s, and 4s, we would see that we were missing a 2. In this case, we're missing the equity investments. So I'm going to come here to equity investments. And now, when I add these in, plus the equity investments, I now have a balancing statement. This is actually a good example because it shows you why it's so critical to have balancing statements. Because if you don't balance the statements and you only do one side, you're not sure that you didn't make a quick mistake like I did and forget to put in an item that needs to be there. If you balance the statement, you know you made a mistake, or you know you have a right answer. So that's the advantage of doing this process. I know it's frustrating, but nonetheless, it will help us make sure we get more correct answers. So again, when you're being graded not that you have the right number, you're being graded that you have the right number and that you can show that you got the right number through a balancing process. It's going to be very important on the grading. But what we now have is a clean, adjusted balance sheet. We have the total investment in the operating part of the business, the investment in the non-operating part of the business, the investment in the debt, the investment in the equity, the operating, non-operating equal the debt and the equity. That's our rearranged Modigliani-Miller balance sheet. Now, we'll do the same thing with the income statement. Call this TII. Gonna make it bigger. Using relative references, copy over the cells. Now, for income, we start, as I said, with my shortcut. I can start with my EBIT. And then I would have taxes on my EBIT. And I believe there was a 25% tax rate, so I'll multiply that by 0.25, giving me my NOPLAT, which is my EBIT minus my taxes on my EBIT of 22.5. Right. That's my only one on this income statement. There are no 2's on the income statement, meaning there was in the balance sheet, but it wasn't generating any income. So there is no non-operating income from the non-operating assets that we are currently reporting. So therefore, my TII equals my NOPLAT, because I add my 1's and my 2's together. I don't have any 2's, so they become my total income available to investors. And that would equal my 3's and 4's. So what are my 3's? Any payments into the debt holders. In this case, it would be the interest expense. And as I mentioned on the video, payments are positive numbers on this statement in the CFI on the financing flow sides because we're matching to the income available. I have income, so therefore I can pay that income out. The positive income is a positive distribution. If I have a loss, a negative number, I would have a negative inflow. So again, I'm going to have to flip this sign to match that convention, and that would be my interest expense. Except here's the thing. There's tax impacts. So there is a tax shield. I get to deduct this, and I am spreading out the taxes into each of the areas. So what I would do is I would take the interest expense and I'd multiply that by 0.25 because that's how much I would deduct on my taxes as savings by being able to have interest as a deduction. So therefore, I have my after-tax interest expense, which is my pre-tax interest minus the tax shield. And then I have my fours, which is my net income, which is the bottom of the income statement. Income statement ends with income. That's why dividends are not on this statement, by the way, because basically income ends with income statement. Dividends are from the cash flow statement. Just happen to put them below net income because you need that data to do the CFI, but nonetheless, the income statement ends with income. That's why TII ends with net income. So in this case, I add my 3s and 4s together, my after-tax interest plus my net income, and I get balancing statements. I have this 22.5 paid out to this amount to the debt holders, this amount to the shareholders, the two balance. Right? And again, that's the key, is I need to create balancing statements. So I have a balancing TII. Now I go on to the more difficult statement, which is the CFI. Cash flow available to investors. Again, from a process standpoint, very important. I have to do the income statement and balance sheet first before I can do my CFI, mainly because the CFI is the income statement minus the change in the balance sheet. That's cash flow. And that is the process that we're going to repeat 4 times. 1 for operating, 2 for non-operating, 3 for debt, 4 for equity. It's important to remember that that's the process. Also, because we do a change in the balance sheet, even though we have 2 years worth of numbers, we can only do 1 year worth of cash flow because we need the change in the balance sheet. So on your homework assignment, I'm going to give you 3 years worth of financials, which means you'll have 3 years worth of TII, 3 years worth of TFI, but only 2 of CFI because you need the change in the balance sheet. So let's start out with the first CFI, the operating, which is free cash flow, is gross cash flow minus gross investment. Well, by definition, gross cash flow is our NOPLAT, right, which is operating at this point, plus any depreciation. Now, since I'm adding depreciation, I'm just going to flip the sign. So instead of subtracting a negative, I'm going to add a positive. And that would get me something called gross cash flow. So my gross cash flow is my NOPLAT plus my depreciation. And from that, I'm going to subtract my gross investment. And again, as on the video, shortcut for gross investment is change in invested capital. So current year minus previous year plus current year's depreciation. That is my gross investment. Now, I can also get this on a more granular basis by taking my change in operating working capital equals current year minus previous year. Then I take my change in net PP&E. So I'm going to call this actually capital expenditures, CapEx, equals the change in net PP&E plus depreciation. So I spent that much on CapEx, and I can verify that because if I start with 400, I add 150, I get 550. I have 50 depreciation, I get 500. That is my ending net PP&E. So my total gross investment is the sum of those two, 92. So this is the shortcut. And that is the more granular way of getting to the same answer. So free cash flow equals gross cash flow minus my gross investment. So I'm spending more cash investing in my business than I'm generating. Right? That's what I clearly, quickly see from having the negative free cash flow. From here, I then add any non-operating cash flows. Any non-operating cash flows to the income statement? I don't have any, but on your homework, you will. Right? Then I look at any non-operating cash flows in the balance sheet. So I have my change, in this case, on TFI, in excess cash, and change in equity investments. So change in excess cash, change in equity investments. So in this case, my excess cash went from 73 to 24. So it went down by 49. Now, what I'm ultimately trying to get to is what we call CFI, cash flow available to investors. And as I mentioned in the video, we want to treat an increase in excess cash like moving money to our savings account. If we're moving money to a savings account, we're using our checking account to pay our bills. So in this case, we're going to have less money available to pay our bills, less cash flow available to pay our investors. So if my change in excess cash is negative, it is going to reduce my CFI, right? Because I'm basically taking away cash that otherwise could have been used to pay my bills. Next, change in equity investments. My equity investments went from 20 to 30. Well, if I went from 20 to 30, I am adding to my equity investments, which means, got to think about the cash impact, I'm spending cash. So I'm going to have to flip that sign if I'm going to add this number together. So I'm actually using $10 worth of cash. So my CFI, the sum of those three, my ones and my twos, which would be the negative 78.5. Okay? So I'm using free cash flow. I'm tying up excess cash, right? Because I can clearly see that excess cash is going down, right? Sorry, I am freeing up excess cash. Sorry, I'm having trouble today, time zone change. So I'm going from 73 to 24. I was looking at the other way. So I'm actually freeing up cash. I'm using cash to pay out to investors. I'm taking it, I should say, from savings and moving it into checking by reducing my cash balance. So I actually need to flip this sign. There we go. And then I have a positive 19 CFI, positive 19.5 CFI. It's coincidental, by the way, that the CFI and the free cash flow happen to be the same number with a different sign. But the idea here is that I had no negative cash tied up in my operations. I spent a little money in equity investments, and then I used some of my excess cash balance to fund that, and then had a little bit of excess cash left over to pay out to my investors. So I had 19.5 to pay out. How did I pay it out? Well, on the income statement, TII, I paid out after-tax interest expense of 7.5. And I'm putting this extra column in here just so I can copy and paste over. I don't need 2006 in the CFI statement because I can only do 1 year, but the reason that it's in there is mainly just because I can copy and paste. Then I look at any change in debt. Now my debt went from 200 to 200, so there was no change in debt, right? But let's say there was. Let's make sure we have my sign right. Let's say I went from 200 to 300. I increased my debt. Well, that would mean an increase in debt would be a negative number, so I would have to flip this sign if I were setting this up correctly. All right, but I didn't, so I'm going to undo this increase in debt. So I have a change in debt of 0. Right? Then, here's one of the tricky parts of CFI. I have to look at the income statement impact of the cash to the shareholders, because I got my 3s in there. Now I'm going to get my 4s. So these are 3s. By the way, if I were labeling, these are my 2s. Those were my 1s. Carrying my labels over. There is no income as cash flow because the cash flow of the shareholders is not the income we make. It's how much we paid to them, which is the dividend. That's why we need dividends. So this is one of the tricky parts of CFI. It's not the income from the TII. It's the actual dividend payment to the shareholder. It's not net income. That's where people make the common mistake. This is the cash flow to the shareholder. It's the dividend payment. Then it is the change in the common stock. And again, common stock in this case didn't change. But if it had an increase, we'd have to flip the sign. And just to see this, let's say common stock went down by 10 from 50 to 40. We bought back the equivalent of common stock. We'd have a negative 10 change. Right? Now, actually what's going to happen if you did buy back the common stock, because that would be right, negative cash flows pay out to shareholders. So that would be the right, flipping the sign. But what actually happens if you buy back common stock is that is known as what's called treasury stock, which is a contra account to equity. So if you see a treasury stock go from negative to more negative, then that shows you or infers a stock buyback. And the more negative treasury stock between the 2 years is actually going to be a positive number on the CFI because that is a payment to the shareholder through a stock buyback. And then the other trick is retained earnings is not a cash flow. So even though there's a positive change in retained earnings here, it is not a cash flow. So if I add these items up, the CFI of 19.5 matches the CFI of 19.5. Now, if I wanted to go through and do an ROIC and an economic profit, create a quick economic profit tab. So again, a little bit bigger. Using the relative years, 2000, it's actually this one, equals 2006 and 2007. Then I would have I'll start out with my NOPLAT. And then I would start out with my invested capital. And if I did a boy ROIC, then it would be my 2007 NOPLAT divided by my 2006 invested capital, and that would be the ROIC of about 5%. Let's just say for kicks, I had a WACC of 10%, just to keep it simple. I'll give you that assumption on an exam or an assignment. So my spread is negative. I am destroying value. So my economic profit equals my spread times my beginning of your invested capital would be negative. Calculating it a different way, my NOPLAT minus my capital charge. There's my NOPLAT. My capital charge is my cost of capital times the invested capital. Take the difference between the two. And that is also my economic profit using method number 2. So spread method, actual dollar method. Either way, I am destroying value. I am $23.2 short of making a 10% rate of return during the current period of time. Right? That's what I'm going to need to know when I do my assignment and do my analysis. So analysis, company's cash flow is negative from free cash flow because they spend more in investment than they're generating in cash profit from the income statement. They are generating positive CFI because they're drawing down their cash reserves, even though they're making a small investment in buying more stakes in other companies. And they're using this to pay off $12 worth of dividends and $7.50 worth of interest expense. The company is getting a return on investment of about 5%, 4.9% on an operating basis on its assets. So those are some of the key numbers that we're going to be looking at for a company and where they're coming from the converted economic statements. So again, I'm going to save this file, including all the Excel references, and I'm going to load this file. Where did it go? I'm going to load this file onto Canvas. Now let's talk about the homework. So if I go to assignments, I will see that homework 3 is now available. It is due Monday at 10 a.m. and it's going to be an economic statement conversion. So if I go to and download this file, then you'll see that it's just going to be more complicated data. The nice thing for you is I've done the labeling. It's 3 years versus 2 years, but again, you're just kind of copy and pasting the columns over. It's 3 years versus 2 years, and there are more fields. But again, if you're following the process of 1, 2, 3, 4, then you'll know where to put it in each of the statements. Remember, on TFI, assets are netted against liabilities and equity. So all my ones on the left are netted against my ones on the right. Same thing with my twos. All my 2 assets are netted against my 2 liabilities. And you'll notice here that there are some 2 liabilities. Add those together, TFI. 3 is going to be the interest expense and the debt. And then interest expense is the 3. And then after tax, make sure you put the tax impact and change in debt. And then equity for TFI. Jumping ahead to the CFI. On the TFI, it's all the debt, the 3s, and the equity, the 4s. On the TII, it's going to be the operating income, EBIT, after tax. Then we're going to do the 2s. So you'll have interest income, new item, after tax. You got to tax affect that because anything above taxes is pre-tax. You're going to have a non-operating loss or gain, depending on the year. Again, we'll have to tax impact that, all the 2s. Net the after-tax 2s, add those to the 1s. You'll get TII. Look at any 3s, short-term interest expense, after tax, 4s, in this case, minority interest, which is after tax. So you don't have to re-tax affect that. That's an already after tax item. But you got to look at the minority interest, which is a payment on the income statement to the minority shareholders. So again, the way minority interest works is that when a company buys a minority stake in another company that doesn't run, it calls that an equity investment. And then the income that it gets on that minority stake is called minority interest or equity income. So minority interest to you, the company that has the equity investment, is your equity income. Minority interest to the company that is paying it is an expense. So the way it works is that if I have you as my minority shareholder, I absorb all of the assets in the investment because I control it as if they were all my own. So I take all the assets that I control, less than 100%, but more than 50%, but I treat it as if I owned 100% of the assets, and I add all the assets into my business. I then take the income that goes to the minority shareholder and I separate it out from my income, and that is called minority interest as an expense. So this minority interest expense is paying what I owe the minority interest of the equity investment. On my balance sheet, so my asset equity investment is what I own in another firm. On my balance sheet, I have a equity, which is really a liability to the other shareholders for the money that I owe them that I've claimed as part of my income. The payment to these minority shareholders is this minority interest. So that one can be a little bit confusing in accounting, but nonetheless, minority interest is a payment, kind of like a dividend to the minority shareholders, and it's going to these people, the minority shareholders. They don't get a claim on all of the income. They only get a claim on the piece of the income that's been absorbed into our business, right? And then this is the treasury stock, which is the only other tricky one you're going to have to deal with. And I told you that is the payment or repurchase of shares. So it's a payment to the shareholders from the repurchase of shares that the company is making. So when you buy back the stock, it goes into a contra account on the balance sheet, contra to equity called treasury of stock, and the negative amount is the amount repurchased. So they repurchased $5, negative 5. They repurchased $245 more dollars, negative 250 of treasury stock. They repurchased another 125, or sorry, another 75, negative 325 treasury stock. So these will represent share repurchase, which is going to be key to your CFI and balancing. Note also on the homework assignment that the tax rate is different and the cost of capital is different. What I strongly recommend that you do as part of doing homework 3, which again is due on Monday as an individual assignment, is number 1, the TAs have office hours later today and tomorrow afternoon. If you're really struggling, go talk to the TAs. They will help you with this process. Go back and review this video and or review the original video that I posted on Monday that talks about how to do the economic statement conversion. But homework 3 is now available, again, due Monday, 10 a.m. for all sections. We'll go over it in class on Monday when I return back to the US, and look forward to seeing everybody then. Have a safe and wonderful week. This is going to end our webinar for today. Thank you.